Happy day after 4th of July, home buyers and real estate professionals. Every Friday, we put out a quick 3 to 5 minute video for anyone showing properties or looking at properties to buy this weekend to let you know exactly what happened in the economy, what happened in the news that moved interest rates, and what you can look at in terms of mortgages. So with that, let's jump in. Very interesting week. You'll see we had obviously the 4th of July holiday. So the last 5 trading days includes last Friday. Well, we started at 426 on the 10-year. We ended at 428 on the 10-year. So not a whole lot of movement, right? Well, you'd actually be wrong there. We ran all the way up about 20 basis points higher, almost 1/4% in interest rate, and then slowly through the week came back down and ended up right where we started. In terms of mortgages, you see the opposite here. Mortgages price varies inversely with rate. So when the price goes down, the rates go up. We started at 100.7, we ended at 100.64, but at our lows of the week, we had lost almost 70, 80 basis points in pricing. So long way of saying, for no good reason, which you're going to see here in a minute, rates got worse, then recovered here towards the end of the week, right where we started. So what moved the market? Last Friday, we talked about it. We had the PCE, which is the Fed's preferred measure of inflation, continues to show inflation moderating, making progress towards 2%. Should have helped rates get better. It actually didn't last week. On Monday, we had the ISM manufacturing report, again, showing slowing in the economy, which should be giving a little bit of cover for the Fed to potentially lower interest rates, for yields to come down. And again, another bad trading day on Monday. Tuesday, we started to see, again, more good data, and the market finally turns around and trades the way we would have expected it to. We had the job openings and labor turnover survey, which again shows a good number of job openings, but moderating and continuing to go down. As always, the fear from the Fed is if there's a lot of job openings and few job applicants, then wages are going to go up, which you would think high wages are a good thing, but they are actually inflationary, and that's the way the Fed looks at it. So seeing less job openings moves interest rates better in our favor. Wednesday, another look at the jobs data. ADP, the payroll company, does a monthly survey. As you can see here, continues to trend down, not showing a weak jobs market, but definitely not the strength that we saw for the year or two coming out of COVID. And this is what the Fed is wanting to see. They don't want to see a weak job market, but they definitely want to see it moderate and a little bit lower year over year wage inflation. Now, when we look at later on Wednesday, we had the ISM services. ISM services has been probably the bigger component that's been leading to inflation. Goods and manufacturing have moderated over the last year. Services still elevated. So again, can't see it super great here in this chart, but they continue to come down. They were forecast at 52.6, came in at 48.8, and previously were at 53.8. So they're expected to moderate a little. They actually moderated a lot, and that 50 level is the pivot here. You see the blue line in that chart. Anything under 50 says we're in contraction, which again, because we had a lot of inflation coming from services, this was a good number to see, at least in the short run. We don't want to see a ton of weakness anywhere in the economy, but seeing a little cooling here is good. So yesterday, we were all celebrating the 4th, shooting off fireworks, hopefully barbecuing and having a beer in the backyard. But today, come back in and we had the June employment report. So they were expecting 190,000 jobs, came in at 206, pretty much right in line, a little bit hotter than expected. But inside that report, what we've been seeing for the last 6 or 8 months, big downward revisions to the last 2 months. So when you see this next month, that 206 will probably be well below the 190 that was forecast. So again, we're not seeing job losses. We're still seeing job gains. The unemployment rate went up to 4.1%, still historically very low, just not as tight and inflationary as what we were seeing before. So with that, for those of you who love the technicals, some of you look at this and go, what is all of that gibberish? You can see interest rates, this green down channel, we are still within that downtrend, meaning over time, rates are slowly grinding lower, even though we're not seeing a big move. Those little aqua colored arrows, what I wanted to point out is within that channel, we generally run to the bottom and we go, oh, awesome, rates are getting better. And then we'll run up to the top of that channel. We're still in a downtrend, but for 2, 3, 5 days, rates have got worse. And that's what we saw last week. And then we'll make a run back down to the bottom of that channel. And as long as we keep making new lows in yields keep moving lower, then the downtrend in rates is intact. So again, this is a slow grind, but if you look at this, last week, we came out of the top of the channel for a day or so. It didn't reject or blow out the channel. But as you can see now, likely to make a run down. We have some fairly significant resistance depending on how you draw it, somewhere around 4.24 on the 10-year, maybe 4.21. If we get through that, we're going to make a run down to about 4%, and it's all going to be data dependent. Next week, we get the market mover, the big market mover besides NFP that we got today, we get CPI. The Fed likes to look at PCE, but the market has been trading CPI much more so. So if we get a tame CPI number next week, that could be the impetus to move us below that 424, 421 level. So if I were a betting man, I'd say rates will probably be a little bit better next week. But as you can see in the charts, lots of volatility. We saw a lot of Fed speakers out this week, and probably the best indication that the Fed is getting very, very close to cutting interest rates is this quote from Austin Goolsbee, the Federal Reserve Bank of Chicago president. It says, "We got to this rate when inflation was over 4%. Inflation is now down close to 2.5%, according to PCE, their preferred measure. So if you sit with the rate somewhere while inflation goes down, you're tightening. The reason that you would want to tighten is if you think that you're not on the path to 2%. All of the comments from Fed speakers this last week tell us that they do believe they're making progress towards 2%. They want to see more progress towards that 2%. But at some point, they're going to have to cut because inflation is coming down, and keeping rates at the high level that we're at right now is in effect tightening. And we're seeing all of this economic data coming in and showing the economy slowing. They don't want it to slow any more than it has already. So with that, we always like to show Mortgage News Daily. This is probably the most honest, accurate news that you can see online. If you want to go to Mortgage News Daily, they publish this every day. 30-year fixed right at 7%, down the tiniest bit week over week, flat over the month. The 30-year FHA and VA right at about 6.5%, also down a tiny bit over the month. Now, the reality is we can get well-qualified borrowers rates better than this, 0.25% or so better on an FHA and 1/4 to 3/8 on a conventional. But this gives you a really good number if you're looking at homes and you want to use a realistic rate for what payments are going to look like. If you're looking for guidance on the optimal mortgage program, when to lock an interest rate, what's likely to come next in both the economy and interest rates, we would love to help. All of my contact info is in the description below. Thanks for watching. We look forward to seeing you again next week.